While net income provides the best measure of a firm's economic performance and may be the best indication of a company's long-term potential, we've all heard the saying that cash is king. To get to the long term, one has to live through the short term, and the short term requires cash.
Now, sure, companies can borrow money and companies can sell ownership interests, but you can only borrow so much money before the lenders start to get nervous about repayment. You can only sell so much stock before investors start to wonder about future cash flows. Lenders lend expecting future operating cash flows, and investors invest expecting future operating cash flows.
Let's talk about operating cash flows, specifically a company's operating cycle. The operating cycle is the length of time from when a company purchases inventory for resale to when the company receives the cash from the sale of that inventory.
In other words, how long does inventory sit as inventory until it's sold? And how long must the company wait to receive payment from the customer? Now, if the customer pays in cash, then the company obviously doesn't have to wait very long. But if the customer buys on credit, it may be a while before the company sees that cash. And the longer the company has to wait to get its cash, the longer the operating cycle.
Now, there are two ratios that are easy to compute that quickly tell us the length of a company's operating cycle: days sales and inventory and average collection period. Days sales and inventory tells us how many days inventory sits in the company on average until it's sold. Average collection period tells us how long, in days, a company waits on average to collect amounts due from customers. Let's look at each of these ratios individually.
Two widely used measurements of how effectively a company is managing its inventory are the inventory turnover ratio and number of days sales in inventory. Inventory turnover provides a measure of how many times a company turns over or replenishes its inventory during a year. It's calculated by dividing cost of goods sold by average inventory. The average inventory amount is the average of the beginning and ending inventory balances.
Inventory turnover can also be converted into number of days sales in inventory. This ratio is computed by dividing 365, or the number of days in a year, by the inventory turnover.
The number of days in inventory and inventory turnover ratios are key indicators that management watches closely each period. Individuals analyzing how effective a company's inventory management is would compare these ratios with those of other firms in the same industry and with comparable ratios for the same firm in prior years.
Now, let's use a company we're all familiar with as an example: Procter & Gamble. Makers of Tide laundry detergent, Dawn dishwashing liquid, and Pampers diapers, to name just a few of their many and varied products. Here's relevant information from a recent set of financial statements.
We can compute inventory turnover for 2015 by dividing the cost of sales by average inventory. The result is 6.37. In other words, P&G turns its inventory over about 6.4 times a year on average. Dividing 6.37 into 365 days tells us that on average, P&G's inventory is held for just over 57 days.
Now, is that good or bad? Well, that depends on a lot of factors, but we can do the same computation for 2014 and find that P&G's days sales and inventory dropped from about 61 days to 57 days. So they were able to reduce the amount of time that inventory remained unsold by about 4 days.
Well, now, once inventory is sold, how long until cash is collected from customers? We do the same sort of computation using different numbers to compute our average collection period. Again, for Procter & Gamble, we obtain the following information related to sales and accounts receivable.
By dividing sales by average accounts receivable for 2015, we can determine that P&G turns its receivables over about 13.5 times. Dividing that number into 365 days results in an average collection period of about 27 days. In other words, those who buy from P&G pay in about 27 days.
So what do we know? Procter & Gamble buys or produces its inventory and holds it for about 57 days. Once the inventory is sold, P&G waits about 27 days to collect the cash from the sale of that inventory.
P&G's operating cycle is 84 days, or the sum of those two numbers, 57 plus 27. Said another way, P&G turns inventory into cash in 84 days.
Okay, now what? Now P&G can start to manage its business differently if it wants to change the length of its operating cycle. If, for example, the company wants to shorten the time it takes to eventually collect its cash, there are two levers the company can pull. It can work to reduce the time it holds its inventory, or it can reduce the time customers take to pay.
Management can develop and execute business strategies relating to these issues and then use the two ratios we just computed to measure the effectiveness of its strategy.